Right, good morning, everyone. This is the first session that I'm trying to eat, so we will see how we get on with this. All right. Really, what I want you to do is I want you to comment on this video when you do end up watching it, and just tell me what you think. Tell me if it's workable. Tell me if it's not workable. Tell me if you've learned anything. But more importantly, tell me if you need me to go to something else. Okay. And again, whether that means we do a bit of live teaching, or whether I just maybe do some more questions. Just let me know. Comments. It's the only way this is going to work. Okay. So essentially what we're going to do is we're going to look at national income again, and we're going to look at this thing called a multiplier. All right. And I'm going to run through a few questions. All right. I have 15 minutes scheduled for this. If I go over this, or if I think I'm running close to it, I'm just going to stop it, and then I'm going to create a second video. Okay. So a couple of things we need to know. We kind of finished on, where are you? This thing, circular flow of income. Step 4. Yep. So this is where we kind of finished the last day. I think we might have looked at trade cycles as well, but let's just stick with this at the moment. So flow of income, money in an economy. So where does the money come from? Where does the money go? We've talked about this ad nauseum. So you should be familiar with this diagram. You should be able to draw it. It shouldn't be an issue. So we're going to tip away. We're going to tip on, and we're going to start now looking at calculation of all of this income in an economy. And if you have a pen and paper, now again, all these PowerPoints will go up, but it's no harm if you had a pen and paper maybe in front of you. And so what I want you to do now is pause the video, pause, and grab a pen and pencil and paper. So income, how do we classify it? I spoke to you the last day, or 3 weeks ago at this stage. I said that to make this simple, we all have these mathematical symbols, or we just classify them in particular ways. So income is Y. Income is equal to consumption, which is C. Investment, which investment by companies, is I. Government current expenditure, so what the government spend their money on, that's G. And then we do this thing called exports minus imports. And exports minus imports, I forgot to put the M there on imports, by the way. Someone correct me. So exports minus imports. Now, going back to business studies, you would realize that when we export something, money comes into the economy. When we sell something to the French give us money. When we import something from France or the UK, money goes out. So exports are a positive thing. They're a positive injection into the economy. We export something, money comes in. So what you really want to see, we'll do this later in balance of trade, is you want to see exports higher than imports, because that means there's more money coming into the country than leaving it, if that makes sense. Okay, so you need to know this. Y is equal to C plus I plus G plus X minus M. Yeah, we're on board? Cool. Okay, there's theory in this, okay? You all have the, what happened there? There's a bit of theory in this, and I'm not, to be honest with you, I'm not going to really go through the theory of it. You all have books. You all can read this. It's a waste of my time now for me literally just to read from the book, okay? So the next 4 slides are in essence just what is C, what is I, what is government, what is G, what is X minus M. Okay, it's all here, what does consumption depend on? Why do we eat? Income, or why do we buy stuff? We talked about this. How much money you have, how much credit's available, what's the rate of interest? We've talked about that. What's the situation with taxation? Okay. What does investment mean? We've talked about this as well. Cost of capital goods. So what is the cost of building a factory cost? Expectations in the future, government expenditure, again, yada, yada, yada. Productivity, capacity of the economy, state of technology. So why do you invest? Why does a company invest? Why does Facebook invest, or Uber invest, or any of these companies invest? It's all there. Okay, you know this. I'm going to belt through it really quickly. What do exports? So why do we export? Again, this is all theory. You can all read this in your own time. Essentially this, okay, we're looking at level of incomes abroad. So the French buy off us because they have money. So then they have no problem buying the Kerry gold off us. Competitiveness, if Irish goods are better, people buy it off us. Value of the euro, obviously if it's the UK or America, they can buy it just because it's cheaper relative to their currency. We'll do all that later on. And then the last thing is government incentives. So every St. Patrick's Day, for instance, all the government parties, they bail out of the country just to create kind of partnerships. And here it says their trade missions and all that nonsense. Okay, so you can read all this. And what do imports depend on? Why do we import stuff? Well, you know yourself. Why do you import stuff? Why do you import stuff? Why do we buy stuff from China? Why do we buy clothing from Thailand? Why do we buy Kellogg's cornflakes from the UK? Well, because you can't get them here. And all the rest of these, all the rest of the stuff as well. You can read it there. So the value of the euro, incomes, farm prices, availability of goods. Don't worry about this thing called MPM. We'll do that in a second. Okay, that's bringing us on to this interesting thing called the multiplier. This is where you need your pen and paper. Okay. So in essence, what does the multiplier? Here's the book definition of the multiplier. It shows the precise relationship between an initial injection into the circular flow of income and the eventual increase in national income resulting from the injection. And a change in spending will cause blah, blah, blah. You can read that yourself. Now, in essence, what this means, and we spoke about this about a month ago, we said during a depression, what does the government do? And we said one of the ways a government can get the country out of a recession is they spend. So if the example that we used was during the Great Depression, the US highway system was built. In the Irish context, you build stuff, you inject money into the economy in the hope that that injection will snowball, will kind of have a snowball effect into the wider economy. So do you remember we talked about that? We talked about the highways, $1 billion to build a highway, but that $1 billion is spent by the workers in the shops. $1 billion is spent by the shops then on purchasing more goods. So it snowballs from there. And the question we do in economics, or the question we have in this course is, by how much? By how much? So if the government intervene and invest $1 billion into new roads or in an airport, what will that translate to? Will it translate into a 2 billion injection, a 3 billion injection, a 4 billion injection? It's called a multiplier. Okay. So before we do that, there's a lot of these things you need to know. Why is this not in order? Sure, why would it be in order? Okay. So the first thing we need to know, and these are all book definitions, by the way, but you do need to know all these things. So there's 4 things you need to know. 5, I think. The first one is called the average propensity to consume. And this means of your income, how much do you spend? So some of you might have a weekend job, some of you might have a part-time job, some of you might not. How much of your income do you spend? And it's generally high. Okay. For me personally, I probably spend about 99% of my income, to be honest with you. And what do I do with the remaining 1%? Well, I save it. I spend everything. I spend my money. I spend it on shopping. I spend it on mortgage payments. I spend it on everything. So you spend. It's called the average propensity to consume. So this word consumption means spending. If I consume, I spend. And here in this example here, an employee receives 100 euros in wages over a weekend, spends 80 euros. Well, they're spending 80% of their money. And if they're spending 80% of their money, they're obviously going to save the other 20% of their money. That makes sense? I hope it does. And next one is this thing called marginal propensity to consume. Why does it say click to add text there? That's really annoying. Ugh, forget about it. Anyway, this is the same sort of thing, but there's a concept in economics that there's a word in economics that I've told you that you need to know about. This thing called marginal propensity. Marginal is the additional. It's very rare that you're going to have to calculate this. So you just need to understand that this thing called MPC. And MPC is quite similar to APC. It's just looking at if you receive more money, how much of that are you spending? If you receive an increase, if you receive additional income, how much are you spending? So in this situation here, we have this employee earned 110 euros and she spends 9 out of this additional tenner. So she gets a tenner raise from her previous money. So she earned a tenner. She spent 9 quid. So what's MPC? It's 90%. Any additional income she's earning, she's spending 90% of it. MPC sounds complicated. It's really not. It's not. It's just how much of your income do you spend? And the marginal part of it just means additional income. Okay. We clear? Yeah, cool. Move on. We also have this thing called a marginal propensity to save. Now, hands up. If our MPC figure is 90%, what do you reckon our MPS figure is? Well, marginal propensity to save is how much we save. And if we don't spend money, we save it. So MPS is essentially just what's left over. So in the previous example, 90% of additional income was spent, leaving 10% to be saved. And there's a very simple formula. You need to know this. Can you take this down? Can you highlight this in your little notes copy or something? Can you highlight that? Can you take it down? MPS is equal to 1 minus MPC. So if 1 is 1, MPC is 0.9 or 90%. 1 minus MPC, this is all in relative terms, is 10% or 0.1. So again, in decimals or in percentages, whatever works for you. So how much you save is how much you spend minus 1. That makes sense. Okay. Yeah, we're on board. Cool. I'm belting through this. That's fine, but this is all theory. Okay. Ask me questions on this. Leave a reply after this if I'm going way too fast. I possibly am, but such is life. We've got a lot to get covered. Okay, marginal propensity to tax. So when we looked at our big circular flow of income diagram, we saw the government. So what's the government's relationship with us? Well, they tax us, unfortunately. And this tax means that this is money that we now cannot spend. So if we're taxed, I pay about 30% tax. So all my income, whatever my salary is on, I think I'm on 55 or something like that. Like I still have to pay tax on 30% of that. I can't spend it. I can't inject it into the economy. Now the government can, but that's not me. That's not what I do. So we need to take into account the tax that I pay all the time, and this is called MPT, marginal propensity to tax. We don't choose what to spend our money on tax on. The government spend it, so it's out of my hands completely. But I need to take into account of it. Okay, and as a result, if they take 30% of my income, it means I cannot spend all my income in the economy, which means the multiplier formula is affected. The whole injection of money into the economy and what the repercussions are is affected as a result of that. If the tax is really high, my spending would be way down. Okay, and there's a little formula for that as well. Can you take this down as well? The multiplier effect of taxation is equal to 1 all over 1 plus MPT. Okay. Great thing about this is you can watch it again and again and again. How much fun would this be? Right, so that is that. And then the last one is about exports and imports. This is the last one, I promise, before we get to the main formula. Okay. This is called the marginal propensity to import. So again, we talk about us spending our money. But when we spend our money, most of us spend our money on imports. I think you would agree. Look at Brexit, look what's happening to the supermarket shelves at the moment. Some of them are starting to become bare. Okay, this is another topic of discussion. Okay, nearly everything you consume is imported. That's a problem because when you buy something in Tesco or Dunnes or Elvery's or Champion Sports or any of these shops, that money is eventually sent out of the country. You buy your Nikes, your Adidas, that money is sent out of the country. That's not good for the Irish economy. So we need to take that into account. Does that make sense? I hope it does. Okay. We're in Ireland, but we need to get our oranges from Brazil. We need to get our chilies from somewhere. Like we spend all our money outside of the country. So there's no point in saying, the money we spend in Ireland. We don't spend in Ireland. We spend in a shop in Ireland, but that shop has to pay the importer for the goods that they did. So this is called the marginal propensity to import. Right. So there is marginal propensity to consume, marginal propensity to save, there's marginal propensity to tax, and then there's marginal propensity to import. So MPC, MPS, MPT, and MPM. The great thing is you don't have to remember all these because they are in the formula book in the maths tables. Okay. Essentially, this is what the multiplier is looking at. And I'm going to stop here in a minute. I actually need to check my time because I'm probably going to go over time. So give me a second here. 13 minutes. Yes, I'm going to stop here in a second, but I want to just finish it with this one here, which is the multiplier. If you haven't a clue what I just said there, have a look at this. This is from the book. What's the situation here? John, he receives an increase of 100 euros per week. He spends 80% of that, and he saves 20% of that. That 80 euros that the dentist gets, the dentist spends 80% of that on hiring a painter to paint the surgery. The painter is hired by the dentist, gets 64 euros, and he buys a new set of glasses from the optician. The 64 euros that the optician gets, he spends 51 euros 20, blah, blah, blah. You can see what's happening here. And really what it means is the original 100 euros that John has spent is now circulating through the economy. And it gives you a total spend in the economy, 500 quid. Have a look at that. I'm going to stop here.